Hello everyone, I hope you guys are doing well and studies are going in full swing. Now in today's video, we are going to discuss about this chapter of business valuation in your CA final AFM. To be honest, this is more like a khichdi chapter where the topics of mergers, security valuation, portfolio, etc. All of these are kind of used. To be honest, at most of these questions that we will be discussing will be covered in each of these respective chapters. Whether you have done classes from us or maybe from someone else, most of the business valuation questions would be covered in some of the other respective chapters. But again, a student is generally, when they open up this in the study material, they freak out a little because there are quite a few questions over here. So what we will do today is we will discuss all of these questions in terms of the concepts. You will have concepts of free cash flow, which I believe you would have discussed in valuation, and multiple based valuation. So you will have P multiple into, let us say, earnings, or you will have EV by EBITDA into EBITDA and so on. Then levered and unlevered beta concepts. So this is regarding private company valuation, where you will first try to find the asset beta or the unlevered beta, and then use the debt to equity ratio of your company to find the relevered beta and use that into the workings. Then you have EVA, MVA, economic value added or market value added, which is done over here and also to some extent in the mergers and acquisition section earlier. And you will have merger evaluation, and then a few new topics have been added, like like your distressed company valuation, startup valuation, etc., ESG, for which we have a separate dedicated video. I can share the link for the same, where we have discussed regarding these topics and also new questions pertaining to that. So the focus of today's video is largely to revise the concepts and at the same time do all the questions that are there in the institute study material in a very quick span of time, so that you can kind of get this chapter to rest once and for all, spend close to an hour and get this out of the way. All questions we will kind of cover. So there are close to 5 or 6 illustrations over here and close to 15 or 16 test your knowledge questions. We'll quickly discuss this. Again, I'm not going to sit and solve each and every one of them. I will discuss the important parameters, and we will also cover each of these questions wherever required. Where we need to go into length, we will go into length. Okay, so over here we will start with your first illustration, which is on page number 13.13. this is illustration number 1. Now there's a privately held company X Private Limited operating in the retail space and is scouting for angel investors. There are a few details. The company has achieved break even this year with an EBITDA of 90. The unlevered beta is like the industry, the asset beta as you call it, for the industry in which it operates is 1.8, and the average debt to equity ratio is hovering around 40:60. So we'll assume that is also the debt to equity ratio for you. The rate of return provided by risk-free bonds is 5%, and the EV is a multiple of 5 times the EBITDA. The accountant has informed that the EBITDA of 90 includes an extraordinary gain of 10 and a potential write-off of preliminary expenses of 20, which is still pending. So what you need to do for the purpose of multiple based valuation is you need to find your recurring EBITDA or your normal EBITDA, which is after considering any expenses which should have been written off and are not written off, or after removing extraordinary items. So when you look at the EBITDA of 90, this includes 10 rupees for extraordinary item which you will remove, and 20 rupees which should have been written off and is not written off, which you will also deduct, and hence your recurring EBITDA or normal EBITDA is 60. Multiple over here is 5 times the EBITDA, and then 60 into 5, this is equal to 300, will be the valuation of the entire enterprise based on the multiples. The internal assessment of the market rate of return is 11%. We have been told that the risk-free rate earlier is 5%, and the free cash flow for the next 3 years is as follows. So you are given that, and the pre-tax cost of debt is 12%, and the tax regime is 30%. So your KD, which is post-tax, will be 12 into 1 minus 0.3, which will possibly, I think, be 8.4%. Now, if I want to calculate KE, what is the potential value to be placed? So one of the value is 300. Another value can be, when you look at KE, this is RF plus RM minus RF into beta. So this is 5 plus 11 minus 5 into the beta. Now the problem is what you have been given is the unlevered beta. Now you will have to lever it based on your debt to equity. So there are multiple ways in which you can solve. The formula over here can be beta asset equals to beta equity into equity upon debt into 1 minus T plus equity. Now I have the unlevered beta as 1.8. I don't know the equity beta, into equity, which is I think 60 upon 40 into 1 minus 0.3 plus equity. So if I take 1.8 into, this is what, I think 40 into 0.7 plus, so 40 into 0.7 plus 60 will come to around 88 upon 60, which is equal to beta equity. So this is into 1.8 divided by 60. So this comes to 2.64. So I will use this 2.64 to find my KE, which is 6 into 2.64 plus 5 comes to around 20.84%, and I will use this in my CAP, I'll use this in my WACC workings so that I can find the discount factor. So my KO or WACC will be 8.4% into, let us say, 40 by 60 and 20.84% into, let us say, 60 by 40. So if I do this, 8.4 into 40% and 20.84 into 60% comes to, let us say, 15.864. As you can see, this is your WACC, and this is what you will use for the purpose of discounting your cash flows. So your future cash flows for the company as a whole, so we'll assume that this is for the company as a whole, to be discounted at the rate of 15.864%, and that will give you, for example, a discount factor at the rate of 15.864%, and this will give you 272. So the range of values will be from 272 to up to 300. There is no terminal value calculation over here done because you have not been given data regarding the perpetual cash flows. So this is regarding illustration number 1. Next you go to illustration number 2, which is on page 16. A made a gross profit of 10 lakhs and incurred indirect expenses of 4 lakhs, which means your net profit will be 6 lakhs. The number of issued shares is 1 lakh and the company has a debt of 3 lakhs and surplus funds to the tune of 5 lakhs. The market related details are as follows. You have been given the data. What are you supposed to do? Find the per share earning value of the company. Now you do have the earnings, which is close to 6 lakhs. However, you need to capitalize this. So you need a discount rate. So you'll take RF plus RM minus RF. So this is 12 minus 4.5 into the beta factor, which is 0.9. And hence your discount factor will be, I think, into 0.9 plus 4.5, shall say 11.25%. So I will take the earnings, which is 6 lakhs divided by 0.1125. So this is 6 divided by 0.1125 will come to, let us say, 53.33 lakhs. Let us say this is in total. Now what are you supposed to do? Equity value of the company, if the applicable multiple is 5. So this is the second one. First you want to find the earning value. So based on earning, let us say you have been given debt of 3 lakhs and surplus funds to the tune of 5 lakhs. Remember, when you want to find your earning value, this is 53.33 lakhs per share. To this you will divide the number of shares. If you have this, given equity shares is 1 lakh, you divide this by 1 lakh and you will get your answer. Now if I want to find the equity value of the company, I will also have to consider a debt. So my EBITDA over here comes to around 6 lakhs, and on this 6 lakhs into 5, this will come to, let us say, 30 lakhs. So this is my total value. However, this is a value of the entire company from which I'll have to subtract debt. So this is, I think, 3 lakhs worth of debt that you will subtract, and if there is any surplus funds, you will add it. Net debt you take, that is, you will take the debt less the surplus cash over here. So over here this is plus 5 lakhs, and hence your total comes to, I think, 32 lakhs. This is your total equity value. Okay, next is the illustration. Over here you will do the practice for net asset value, calculate an exchange ratio, etc. However, no, this is not, that is probably there somewhere else. So over here this is again, I think, multiple base valuation. Balance sheet of HK is given. You have been given the entire balance sheet and shares are actively traded and the current market price is 12 rupees. The shareholders funds represents 70,000 shares of rupees 10 each and the rest is retained earnings. Calculate the enterprise value. Enterprise value is the value of equity plus the value of debt, which is net debt, that is, add the debt minus the surplus cash or other assets. So over here your traded price is 12, your number of shares, if I am not wrong, is 70,000. So 70,000 into 12 will come to 8 lakh 40. If I take the full numbers, upper balance sheet is given in thousands. If I want to find the enterprise value, this is the equity value to which you will add the debt. That is 200,000 or 2 lakhs that you will add. And if there's any surplus cash, which is 5 lakhs, which you will deduct. Remember, you will take the net debt, that is the debt minus the surplus assets everywhere. That is what the institute does. Earlier, there was some level of inconsistency. Now, the institute almost everywhere is taking the debt minus the surplus cash and solving. So, this comes to 5 lakh 40. This will be your enterprise value, as you can see over here. Okay, next you have the next illustration, I think illustration number 4. This is something which is a multiple based value segment chop stop approach, where you value every division separately and the value of the company is the total of each of these divisions. So using the chop stop approach, breakup value approach, we assign the value for Cornet, whose stock is trading as a market price of 4 million euros. The accounting data for business segments are given below. So for each of the business segments, you have been given parameters, and industry data for pure play firms are given. So over here, capitalization by sales, capitalization by assets, and capitalization by operating income. What do you need to find? Well, the total value. So this is segment sales into 0.75, 8 lakhs into 1.1, 2 lakhs, 20 lakhs into 1. And hence, if I multiply all of these, I will get around 40.05. Similarly, over here, multiply by 0.6, 0.9, 0.6, which will give me 28.8. And lastly, operating income multiplied by 10, multiplied by 7, multiplied by 6. So this will give me the total values for each segment. Total of the 3 will give you the total value. Now, I don't know which value is the best, so I will take all the 3 and take an average. So over here, all of these values divided by 3, and this will give me the final value of Cornet using the given method. Now you have economic value added. On this, there is a particular sum over here which institute keeps on asking. So this is pertaining to, let us say, EVA is usually NOPAT, net operating profit after tax, minus invested capital or capital employed into the WACC. Now, an adjustment over here that the institute does is for provision for bad debts, where it will, while calculating its EVA, which is based on NOPAT, it will take EBIT into 1 minus T, or PAT plus interest into 1 minus T, to which it will add back the provision for depreciation. Now, there's a separate story for that. But what institute always does is it adds back the provision for depreciation and finds the NOPAT. No tax adjustment is done for the same. While even calculating invested capital, it reverses. That is, it adds back the effect for provision for depreciation. But when it has to calculate WACC, it will take the original weights. This is what the institute has been doing, is still done, and hence we will solve it in that particular way. So over here, you will compute the EVA for A Limited. You have the following data, and you are told assume bad debt provision is 20 lakhs. It is including in selling and general administrative expense. It is reduced from trade receivables in the current assets as well. Assume the pre-tax cost of debt is 12%, tax rate is 30, cost of equity is 8.45%. So if I want to calculate EVA, I will have to calculate NOPAT. Now NOPAT is calculated as EBIT, that is 410, into 1 minus T, that is 30%, plus provision for bad debts of 20. Alternatively, you can even do PAT plus interest into 1 minus T plus provision for bad debts. You will get exactly the same answer. This is 410 into 0.7 plus 20, and you will get, I think, 307, which is your NOPAT. Second, you will calculate invested capital. For invested capital, you can either take assets minus liabilities, or you can take share capital plus reserves plus long-term borrowings. So over here, if I take this is 700. Now reserves must be calculated after deducting provision for bad debts. You will add back. So this is 20 added back over here. Even on the asset side, 20 added back over here. So your invested capital can be 700 plus 120 plus 100, and hence this comes to probably 920. As you can see over here, 920. You can even use the asset minus liability route. And then when you calculate WACC, this is cost of debt, that is 12% into 1 minus T. I think this comes to 8.4%. So this is 8.4% into, now the debt over here is 100 divided by, they still take 900 over here. In my opinion, 920 would have been more appropriate, because everywhere else you have taken that reversal for provision for bad debts. But well, we do it the way institute has done. Your K is 8.45% into over here 800 divided by 900. And that will give you the WACC. As you can see over here, 800 by 900, 100 by 900, and hence this comes to around 8.44%. So if I had to calculate the EVA, this will be 307 minus 920 into 8.44%, and that will give you your economic value added at around 229.35. So basically for bad debts, you will add back the provision for bad debts while calculating NOPAT. You will add that even while calculating invested capital, but when you calculate the WACC, you will continue based on the original weights if you want to keep it consistent with the institute solutions. Next, you will have another illustration, I think. So these are, I think, four or five illustrations which are there, and then you have quite a few questions in your test your knowledge section. So most of these questions, if you see, are like a valuation or a merger or a portfolio question, but nevertheless we'll just put this to rest, discuss everything, and then there are a few new topics for which if you want sums, study material does not have that, it has theory. So we have put a separate video where we have discussed all the new concepts along with the sums on the same. So over here, practical questions. ABC is considering acquisition of XYZ, which has 1.5 crore shares outstanding. The market price of the share is 400 at present, and ABC's average cost of capital is 12%. Available information from XYZ indicates expected cash accruals for the next 3 years. So this you will discount at the given rate of 12%. If there is any terminal value, you take that, otherwise you directly apply this. Calculate the range of value for ABC, and present value factors are given. So you will take those present value factors and arrive at the value. So this is 250 into 0.893. Then you have 300 into 0.797 and 400 into 0.712, and you will total this up around 747.15. Now this is for the entire company. If I divide this by 1.5, I will get the value per share, that is 498.1. So range of value, your market price is 400 per share to around 498.1 using the free cash flow method would be the range of value per share. On a totality basis, 400 into 1.5, that is 600 crores to around 747 crores would be the range of values. Next, we have question 2. Eagle reported a profit of 77 lakhs after 30% tax, so this is PAT, for the year 11-12. An analysis revealed income included extraordinary items of 8 lakhs and extraordinary losses of 10 lakhs. So first, this is profit after tax. So if I were to take 100 minus 30 would give you 70. Now 70 is equivalent to 77. Then your profit before tax would be how much? I think this comes to 110. So I'll start at 110. 110 included income of 8 which you will remove, included an extraordinary loss of 10 which you will add back. So you want the recurring income, future maintainable as you say. The existing operations except for extraordinary items are expected to continue. In addition, the launch of a new product is expected, and this new product is expected to generate around 70 minus 20, 50 minus I think 22, that is 28 of profits. So for future, 28 of profits would be there. You are required to calculate the value of the entire business given that the capitalization rate is 14. So over here, this is 110 minus 8 plus 10 plus 28 comes to 140, from which you will subtract tax at the rate of 30%, and hence 98 will be your future maintainable profit. And if the capitalization rate is 0.14, 98 by 0.14 will come to around 700, which is the entire business value. Now determine the market price per share. If the share capital is 1 lakh, 13% preference shares of rupees 100 each and 50 lakh equity shares of rupees 10 each, and PE ratio is 10 times. So if I want the PE ratio, to use the PE ratio, I'll say 98 is my total earnings for the entire business, minus I'll have to subtract preference dividend, which is 1 lakh into 100, that is equal to, I think, in lakhs, 100 lakhs into 13%. So this is 13 for preference dividend. I'm left with 85, and this 85 is your earnings for equity shareholders into 10 will come to 850, which is your total equity value. Divide this by the 50 lakh shares that you have. 850 divided by 50 I think comes to 17 rupees, and hence this is the market price per share. So you will have to take recurring income, and accordingly you will find the answer. Now we will go to question number 3. Now this is what we have done in mergers. It's a fairly detailed question on strategy evaluation, for which you have to have a reasonably good grip for free cash flow understanding. So let us review this. ABC is considering a new sales strategy which will be valid for the next 4 years. They want to know the value of the new strategy. how will you do strategy valuation? That is the value of the company under the new strategy minus the value of the company under the old strategy. So the incremental value will be the value of the new strategy. Following information is given: sales minus margin minus admin expenses. So you'll have 20,000 into 20%, that is 4,000, minus 2,000. So that is probably 2,000 profit before tax minus 30%, and hence PAT is 1,400. So basically 1,400 on the base of 20,000. I'm just doing it simplistically. So this is 7%, which is my PAT. And since everything is variable over here, everything over here is given as a percentage of sales. Then as sales change, my PAT will exactly change. So whatever is the new sales into 7% will give me my PAT. Balance sheet information is there for fixed assets, current assets and equity. If it adopts a new strategy, sales will grow at 20%. So each year for 3 years, and from 4th year onwards, cash flow will be stabilized. So 4th year will be used for the purpose of our terminal value calculation. So cash flow SNE project is only for 3 years. It will continue up to perpetuity because the company will continue up to perpetuity, but the cash flow will be stabilized. The gross margin ratio, which is 20%. Asset turnover ratio. How do you calculate assets turnover? Sales by assets. Now, which are the assets given? There are fixed assets. So your current asset turnover ratio and your current fixed assets turnover ratio will be 20,000 of sales divided by 8,000 will come to, I think, 2.5, divided by 4,000 will come to, I think, 5. And the capital structure and income tax will remain unchanged. Now, if I go to see 8 plus 4 is equal to 12, the entire funds are equity, there is no debt. Depreciation will be at the 10% of net fixed assets at the start of the year, and the company's target rate of return is 15%. Okay. Determine the incremental value due to adoption of the new strategy. So if I go to the new strategy, I'll have to predict sales. Sales over here will increase by 20%. So this is 24,000, then 28,800. 28,800 plus 20% comes to around 34,560. And 4th year it will remain stable, that is 34,560. Now the profits over here at the rate of 7% every year, 24,000 into 7% comes to 1680 of profit. 28,800 into 7% comes to around 2016 of profit, and 34,560 into 7%, 34,560 into 7% comes to around 2419.2 of profits. Even in the 4th year, this will be 2419.2. Now, if I want to find the free cash flow, that is PAT plus depreciation. There is no debt, so there is no question of interest, minus investment in fixed assets, minus investment in working capital. Now, how will I find the investment in working capital? I have been told that my current assets turnover ratio will remain the same. So, if my sales become 24,000, so the formula over here is sales by current assets, this ratio will remain 5. Now, I know what my sales are, I know what the turnover ratio is, so current assets will equal sales divided by 5. And hence, if I look at the current assets, for year 0, they were 4,000. For year 1, this will be sales of 24,000 divided by 5. 24,000 divided by 5 will be 4,800. So, an additional 800 will be invested in working capital in year 2. 28,800 divided by 5 comes to 5,760 minus 4,800, around 960. Will be additionally going in working capital, and in year 3 this will be 34,560 divided by 5 comes to 6,912. So basically your working capital, if I review over here, my working capital will be 4,800, 5,760, 6,912. Initially it was 4,000, so there's an increase of 800 in the first year. So there is 800, 960 in the second year, 1152 in the third year, no further increase in the next year. As you can see, PAT over here we have calculated for each of these. Now we need to calculate the depreciation, for which you need to find the fixed assets. Now fixed assets similarly are going to be calculated. Fixed assets at the end of the year will be calculated as 24,000. That is your sales divided by 2.5, because the turnover ratio remains the same. So this is 9,600. Similarly, in the next year, this is 28,800 divided by 2.5 will come to 11,520. 34,560 divided by 2.5 will come to 13,824, and that will remain the same. Now, I can say that if I look at the difference between these two, this will give me the net impact of new fixed assets bought as well as depreciation. If I want to show them separately, what I can even do is I can prepare, let us say, a fixed asset account where your opening is 8,000, depreciation will be 800. Closing is 9,600, so your balancing figure 2,400 will be the new fixed assets bought, that is capex. In the second year, your opening is 9,600, closing is 11,520, your depreciation will be 960, and hence the balancing figure over here would be around 2880 and so on. So this is how you will calculate depreciation of 800, 960, 2,400, 2880 and so on. Simplistically, you can directly take the difference as well, because you are going to add back 800 and subtract 2,400. Net you are going to deduct net 1,600. You can even take that, and considering that, you will get the cash flows for the first 3 years and then 2419.2 for the terminal value calculation. So 2419.2 divided by KE minus G. I think KE over here is around 15%. So you will take the negative cash flows for the first 3 years and then residual value 16,128 after 3 years, and that will give you the total value at 10,000 and something minus 1961. This is a value under the new strategy. Under the existing strategy, my profit will continue to be at 400. Depreciation will be based on fixed assets 8,000 into 10%. So you will add back depreciation of 800. Capex every year, my fixed assets have to kind of continue. My opening fixed assets are 8,000 at turnover ratio of 2.5. My closing fixed assets should also be 8,000, and hence if 800 is the depreciation, 800 will also be the investment in fixed assets. So over here this will nullify, and even my current assets will remain the same. All said and done, Institute has directly shown 1400 to be the value under the existing strategy. Divided by 0.15, this will continue to perpetuity, and 9,333. So the incremental value of the strategy is as negative 691. So this is, we have done this at length in your mergers and free cash flow valuation, but Institute over here has put this within the residual business valuation heading. Question number 4 is again more like a merger question. Let us review this. H agrees to buy over the business of B effective 1st April 12. The summarized balance sheets are given. So you have been given the balance sheet. Remember, the face value of H is 100, face value for B is 10. H proposes to buy out B, and the following information is provided as a part of the scheme. The weighted average post-tax maintainable profit of H and B are 310 respectively. Both companies envisage a capitalization rate of 8%. So if I look at earnings based value, this is 300 divided by 0.08. Comes to around 3750, and if I look at 10 divided by 0.08, comes to around 125. Now this is total value. If I have to divide by the number of shares, H has I think 3.5 shares, B has I think 0.65 shares. So if I divide this by 3.5, if I divide this by 0.65, I'll get the value per share 3750 divided by 3.5 comes to around 1071.14. This is the value for H using the earnings method, and for B the value is 125 divided by 0.65 comes to around 192.31. Okay, that is about it. Next, H has a contingent liability of 300 crores as on 31st March. This is only with H. Now H is to issue shares of 100 each to the shareholders of B. In terms of the exchange ratio is arrived based on fair value. And how do you calculate fair value? Consider weights of 1 and 3 for the value of the shares arrived on net asset basis and earnings capitalization method respectively. Now I have the value as per earnings capitalization. Now I have to find the value as per net assets. For H, your total assets are 1300. There is no separate fair value minus the liability. Well, there is a 300 rupees contingent liability. And hence, one needs to remember deferred tax assets will be a part of my assets, and contingent liability should be deducted at fair value. If fair value is not given, the entire 300 will be deducted. So this will be 1000. So if I go to see 1000 divided by 3.5, that is approximately 285.71, and next is 31.5, no adjustment is needed, divided by 0.65. This is 48.46. Now, if I want to find a fair value, I will give a weight of 3 to the earnings based values and 1 of the net asset value. So 1071.14 into 3 m plus 285.71 into 1 m plus MRC divided by 4. So your fair value approximately, I'm not sure, comes to 874.78 and 192.31 into 3 and 48.46 into 1 divided by 4 comes to around 156.34. Now if I have to find the exchange ratio, it is target by acquirer, so this is 156.34 upon 874.78 and it will come to around 0.1787. 1787 is to 1. The two important points that you have to remember is while calculating net assets, deferred tax will be a part of your asset base, and while calculating net assets, contingent liability if given will be deducted. So you have to find the value as per net asset, earning capitalization and exchange ratio is to be calculated. If I just verify these numbers, you will get 0.1787. That is right. If that is right, everything else must have been correctly done. Okay, next you go to question number 5. Again, this is something that we have done in mergers. AB is planning to acquire and absorb XY. So XY is the target. The valuation is to be based on recommendation of merchant bankers and consideration is in the form of shares. So we will value based on what the merchant bankers are saying. At 31st March 6, the paid up capital of AB consists of 80 lakh shares of 10 each and the highest and the lowest quotation are 570 and 430 respectively. The purpose of exchange, the price is to be reckoned as an average of the highest and the lowest price of the last 6 months, that is 570 plus 430 divided by 2, which will come to I think 500. This is the average price of the shares that is being issued. Now XY's balance sheet is given to you. Here you have some fully paid as well as some partly paid up shares. An independent firm of merchant bankers have produced the following estimates of cash flows. So you have been given after tax earnings for equity. So this will be discounted at KE to find the value of equity. It is a recommendation of merchant bankers that XY may be valued on the basis of average of aggregate discounted cash flows at 8% and net assets. Now the present value are given, so you have been given everything. So this is into 0.93, 0.86, 0.79, 0.74 and last में terminal value है तो 0.68 and 0.68. So you can try to find the present value of cash flows. This will give you the value of equity because these are free cash flows to equity. Required to find the total value of the business of XY. So over here this is, I mean you can refer the solution directly, but otherwise 105 into 0.93, 120 into 0.86, 125 into 0.79, 120 into 0.74 and I think total of 300 into 0.68. If I total up, this is 592.4. This is a value as per discounted cash flow. Merchant banker says I have to take the average of the two. Net asset value, this is 350 minus 100, that is equal to 250 divided by 2 and hence this comes to around 421.2, which is the average value. Number of shares to be issued, well this is I think everything is in lakhs. So into if I take 1 lakh, this is 4 crore 21 lakh 20,000 divided by 500, which is the average price per share. I have to pay 4 crore 21 lakhs, but I will pay it through my shares which are worth 500 each and hence I'll issue probably 84,240. That is 4.212 crores divided by 500 will give you 84,240 and the basis of allocation among the shareholders. Now there are 20 lakh shares, but they are fully paid, 10 lakh shares which are 5 rupees paid. So I'll allocate in the ratio of the total paid up share capital, that is 84,240 in the ratio of 200 is to 50 and hence into 200 divided by 250 comes to around 67,392 shares to the fully paid shareholders and the remaining I think 16,848 shares to the partly paid shareholders. Remember, when you have to do allocation, you will not take the number of shares, not the paid up value per share, but the total. That is the total paid up share capital held by the fully and the partly paid shareholders to get your right answer. Okay, so this takes care of question number 5. Next, you go to question number 6. The valuation of Hansel has been done by an investment analyst based on the expected free cash flow, so that is for the next year of 54 for the following year, an expected growth of 9%. The analyst estimates the value of Hansel to be 1800. Great. However, he committed a mistake of using book value of debt and equity for WACC. Now, your value here is 1800 equals 54 upon WACC, that is x minus 0.09. So, you can find the x, which is the wrong x. This is 1800 into x minus 0.09. So, this is 162. So this is probably 1800x minus 162 equals 54. Therefore, if you take 162 on the other side, 216 divided by 1800 and 0.12. So your WACC currently is 12%, but that is based on the book values. The book value weights employed by the analysts are not known, but you know that Hansel has a cost of equity of 20% and post-tax cost of debt is 10%. The value of equity is thrice its book value, whereas the market value of debt is 9/10 of its book value. Okay. Now, I don't know the weights. However, I've been told that the value of equity is thrice its book value, whereas the value of debt is 9/10 of its book value. Now, if I have 12%, I can say 12 is the cost of debt, that is 0.1. I think 0.1 plus the weight of debt into the weight of debt. Let's say this is into WD plus the cost of equity into the weight of equity. Now, weight of equity can be 1 minus the weight of debt. This is based on book values. That is 0.12 equals 0.1 WD plus 0.2 minus 0.2 WD. So, if I do all of these workings, I would say that 0.12 equals, let's say, 0.2 minus 0.1 WD. So, over here, if I take 0.1 WD on the other side and 0.12, this is 0.08. Therefore, weight of debt will be 80% and weight of equity will be 20%. So, your debt as per book values will be 80, equity will be 20. Now, market values is debt is 9/10. So, this is 72, 80 into 9 by 10 and equity is 3 times. So, 20 into 3, that is equal to 60. So, my revised weights for the purpose of my calculation should be, ideally, when I do this calculation, I will say the revised weights will be 10% into 72 upon 132 plus 20% into 60 upon 132. That will give me my revised WACC. So, this is divided by 132 and 20 into 60 divided by 132. And hence this comes to around 14.55%. So, this is, you will use this 14.55% for the valuation. So, this is 54 upon 0.1455 minus 0.09. So, this is, I think, 54 divided by 0.0555 and this is 927 or 972.97. This is very similar, or this is exactly the same as the sum that we did in valuation. Now, questions 7 and 8 are fairly detailed questions for free cash flow valuation. We will do that in some time. But ये पूरे free cash flow based valuation, this I think is question 50, 49 or something of the security valuation section. We will review the other questions quickly. Question 9 is on, most of the other questions are linked to concepts like EVA, etc., which are discussed here. With the following information for Jatayu, compute the EVA. So, you have capital structure, 160 reserves, debt, cost of equity. There is a term called as financial leverage. How do you calculate financial leverage? Among other things, if you remember, EBIT upon EBT was a method to calculate financial leverage, which is 1.5 times. So, this will possibly help us in calculating the EBIT. And income tax rate is 30%, sir, but I don't know EBIT, I don't know EBT, but I know that EBT is EBIT minus interest, and interest is 10% of 400, that is 40 lakhs. So, I can say if EBIT upon EBIT minus interest, that is 40 lakhs, is equal to 1.5. So, if I can work around, this is x upon x minus 40 equals 1.5. So, if you take this on the other side, x is equal to 1.5x minus 60, and therefore, I can say 60 equals 0.5x, and therefore x, that is EBIT, should ideally be 120. And once I find EBIT, it's end of story. No PAT will be 120 into 1 minus 0.3, which will come to 120 into 0.7 comes to 84, and capital employed would be 160, 140, that is 300, 700 into the WACC. WACC to yaar, it is easily calculated as a cost of debt, which is 10% into, so this is 10 into 1 minus 0.3, that is 7 into 400 upon 700 plus cost of equity, which is given to us as 14% into 300 divided by 700, and hence this is 7 into 4 by 7 and 14 into 3 by 7, and hence I think this comes to, if I am not wrong, around 10%. So if I take this into 10%, and hence my EVA should ideally come to 14. So if I look at question number 9, you look at this formula which you would have done in your inter C, and ultimately comes to around 14 lakhs. Okay, so this is question number 9. Then you go to question number 10. RST's current financial year income statement reported in net income after tax, that is PAT, of 25 lakhs, and the corporate tax rate is 30%. Following capital structure is given to you. So invested capital is directly given, no problem. You are given the following data to estimate the cost of equity capital. So equity beta is there, sometimes you can even have asset beta. Risk free rate and average market risk premium is there. So this is 8.5 plus directly 9. This is market risk premium, RM minus RF, into 1.36, and hence 9 into 1.36 plus 8.5 comes to around 20.74%. This is your cost of equity. Remember, debt is 11%, cost of debt will be 11 into 1 minus 0.3, which will I think come to 7.7%. Estimate the WACC. WACC is the cost of debt, 7.7 into the weight of debt, that is 40 upon 165, plus the cost of equity, 20.74 into the weight of equity, 125 upon 165, and then EVA. Now for EVA you will have to find, let us say, your NOPAT. NOPAT is PAT, that is 25 lakhs, plus interest into 1 minus T, which is 40 lakhs into 11% into 0.7. So this is 3.08, and hence if I add this, this is I think 28.08 minus the invested capital of 165 into the WACC. WACC क्या होगा? 7.7 into 40 divided by 165 and 20.74 into 125 upon 165, and hence this is around 17.58%. So this is 165 into 17.58%. This is around 29. It seems to be a negative EVA. Let us just verify this, of around point something. So this is on my next question. 20.74 ठीक है. WACC is 17.58, perfect. 35.71 would be my O. They have done it in a slightly different way, but I think NOPAT आपको same आना चाहिए ideally. EBIT into 1 minus T, 28.08, perfect, minus 29, and hence a negative 0.9 would be your EVA, perfect. So this is your question number 10. Next you go to question number 11. Tender has earned a net profit of 15 lakhs after a tax of 30%. So this is your PAT. Interest cost charged by, interest cost charged by the financial institutions was 10 lakhs. So this might help me calculating the EBIT. The invested capital is 95 lakhs, out of which 55% is debt. The company maintains a WACC of 13%. Calculate operating income. So you will calculate backwards EBIT, which I don't know, minus interest. Interest is 10 lakhs, gives you PAT, minus 30. So 100 minus the tax rate, I think is 30%, will give you PAT, that is 70. Now PAT is 15. So if 15 divided by 70, so this is just 15 divided by 70 into 100 comes to I think 21.42. And if I have to adjust 10, this is 31.42 or 43 as the case may be. That is your operating income. Economic value added is very easy. Once you find the operating income of 31.43 into 1 minus 0.3 minus invested capital of 95 into 13%. So this is what? 31.43 into 0.7 and 95 into 13% comes to around 9.65 approximately. Okay, 9.65. Tender has 6 lakh equity shares. How much dividend can the company pay before the value starts declining? So we'll assume that the entire EVA I can pay off residual excess over what is minimum required, 9.65 divided by 6, and hence around 1.6 or 1.61 should be the dividend that I can possibly pay. So if I go over here, this is 1.60 of dividend, 9.65 of my EVA, and operating income come to around 31.43 lakhs. So this is a quick review for question number 11. Then you go to question number 12. The information is for 3 companies which are identical in their all respects except their capital structure. You can do it for one of them, the same applies to the others. You have been given some data, and then tax rate is 35% in all cases. Compute the WACC for each company. Let's say we do this for Orange. For WACC, you will take the pre-tax post-tax cost of debt. So this is 16 into 1 minus 0.35 into debt to assets. So this is 0.8, that is a weight, plus cost of equity, which is 26%, into the weight of equity, which is 0.2. So this is 16 into I think 65 into 0.8 M plus and 26 into 0.2 M plus MRC. This is 13.52%. Okay, compute the EVA for each company. Well, this is 25,000. So 25,000 for Orange into 1 minus 0.35 minus the invested capital, which is 1 lakh, into 13.52%. So over here, this is 25,000 into 0.65 minus 13,520 comes around 2730 EVA for Orange. You can try it for Grape and Apple, it is similar. Based on EVA, company would consider which of them would be best for investment, whichever is highest. If the industry PE ratio is 11, estimate the price of the share of the company. Now the thing is, I have EBIT, which is 25,000 minus interest. Now if my debt is 80,000, because 1 lakh into 0.8, इसके ऊपर interest will be 16%. 80,000 into 16%, 12,800. 25,000 minus 12,800 comes to around 12,200, minus tax of 35% will come to 7,930. Now 7,930 divided by the number of shares, that is 6,100. That will give me the EPS of 1.3 into 11 times the industry metric, and hence this is 14.3, which is my market price. Calculate the estimated market value. Well, I'll multiply 14.3 with around 6,100 shares, and hence 87,230 will be your total market cap. So if you review over here, this is, I think ultimately 87,230 is correct. Everything that has gone into the flow seems to be correct. You'll have 13.52, 2730 and so on. So this is question number, I think 12. Next you go to 13. Delta's current financial year reports net income as 15 lakhs. Delta's tax rate is 40%. Interest expense was 15 lakhs. Delta has 1 crore of invested capital, out of which 60% is debt, and it tries to maintain WACC at 12.6%. Required to calculate operating income or EBIT. Well, again you have to work backwards. That is, if 15 is my PAT and my tax rate, for example, is 40%. If 15 is equal to 60, then 100 is equal to how much? Probably 25. So this is 25, and then uske upar 15 ka interest lag raha hai. So ideally 40 should be my EBIT. What is EVA of the current year? So well, EVA can be calculated as 40 into 1 minus 0.4 minus invested capital of 100 into WACC of 12.6%. So 40 into 0.6, that is 24 lakhs minus 12.6, and you will get 11.4. And if they have 2,50,000 shares, according to EVA, how much should the Delta pay dividend before the value would start decrease? So this is divided by 2.5, and hence your EVA based dividend will be 4.56. So EVA is generally over and above what is required. So if you pay that, that is permissible, because that is in any case excess of what is required. So this is, I think, the first part, 40 lakhs, EVA is 11.4 and 4.56 will be your EVA based dividend. Okay, that takes care of question number 13. Then you go to 14. The data is given for a software consultancy business. Your entire data is given, and you are asked to prepare the EVA as well as the MVA, given that the WACC is 12% and the share of the company is quoted at 50. Now this will help you for MVA. For EVA, you will take the NOPAT. which is maybe 180 into 1 minus t. You can even do it the other way around, 180 into 1 minus. What is the tax rate given? 35%. Minus invested capital. What is your invested capital? अगर ये सबका अपन total मारे, so over here this is 100 plus 325 plus 180 comes to 605 into 12%. So this is 180 into 0.65, that is 117, and 605 into 12%, that is 72.6, and hence 44.4 will come as the EVA. Market value added is the total market value. Now value of debt can be assumed to be equal to the book value of debt. So the change will be primarily due to equity. So your equity is 10 million stocks at the rate of 50, and hence that is equal to 500. That is your market value. Plus if you want to add, you can add debt of 180, and hence 680 will be the market value compared to the book value of 605 for the entire enterprise, and hence ideally 75 would be the market value added. So if we verify this at the end, you will have EVA at 44.4, MVA at around 75. You can even do it only for equity or conceptually for debt and equity both. Question number 15. You will have Herbal Gyan, a small but profitable producer of beauty products, is using the plant aloe vera. It is not a high-tech business, but Herbal's earnings have averaged around 12 lakhs after tax. So this is earnings, largely on the strength of the patented beauty cream. The patent has 8 years to run, and Herbal has been offered 40 lakhs for the patent. Herbal's assets include 20 lakhs of working capital, 80 lakhs of property, plant and equipment. The patent is not shown in Herbal's books. Suppose Herbal's cost of capital is 15%, show the EVA. Now the thing is, tax rate is not given, and hence over here your EVA will be the same as your PAT. Again, data regarding interest is also not given, so your EVA will be same as 12 minus invested capital. Now invested capital, instead of share capital and reserves and loans, we will take assets, which is 20 plus 80. But even the patent, even if it is recorded in the balance sheet or not, it will be added to your invested capital because it helps you in earning the income, and hence this will be 140. So this is minus 140 into 15%. So this is 140 into 15%. This is 21, and 12 हमने कमाया है. So this is, I think, 12 minus 21, it's a negative 9. Okay, similarly you have question number 16. Most of these questions you see are EVA questions. Constant Engineering has developed a high-tech product to reduce carbon emission. The product is in high demand. The product has been patented and has a market value of 100, which has not been recorded, but in invested capital you will record. Net worth of Constant Engineering is 200. Achha, this is based on books, जिसके अंदर 100 नहीं है, and hence the invested capital will be 200 plus 100. Long-term debt is 400. The product generates a revenue of 84 crores. The 365-day government bond is 10%. Market portfolio is 12%. And stock of the company moves in tandem with the market. So over here, if I had to calculate KE, this is 10 plus 12 minus 10 into the beta of 1. So this will give you 12% KE. Calculate EVA of the company. Now the problem is there is debt. I don't know the rate of interest in the debt. It is reasonable to assume that the rate of interest will be around 10%, which is similar to the cost of the bonds. You don't have the interest rate, you don't have the tax rate, and hence if I had to calculate the WACC, my WACC will be 10% into the weight of debt, that is 400, upon the total of 700 plus 12% into the weight of equity, which is I think 300 upon 700. We'll just verify this once. Remember, your 100 rupees is attributable to equity shareholders, not debt. Why? Because debt को 400 ही मिलेगा, equity का भले books में 200 है. If it liquidates, the money after paying 400 will entirely go to the debt. So over here, if I go to see, I will take 300 for equity, which is 200 of net worth plus another 100. Okay, and hence that ways my WACC comes to 10.85%. There have been no data regarding expenses, so we'll assume that the profit is 84 minus invested capital of 700 into 10.85%, and hence 700 into 10.85%, 75.95 and 84 comes to around 8.05. This is your EVA. So basically for EVA, 2-3 adjustments you remember. First is if there's a provision for bad debts, you add back the provision for bad debts without doing any tax adjustment in NOPAT calculation, also consider that in your invested capital, add it back, but in WACC ignore it. If there are any unrecorded assets like patents, etc., then you add it in your invested capital and also consider that for your WACC calculation, as you can see over here. So this kind of takes care of all of these questions except for those two big questions which are largely valuation questions, which we will review and close out all the questions from this chapter. So these are kind of similar questions. You will go to question number 7, please. increase by 20%, less working capital. So so whatever be the capex, whatever is the depreciation, they're going to offset each other. Now, whatever is your earnings after tax, basically, if I go to see, what is the question telling me? Your earnings after tax will grow at what rate? 10%. So, अगर मेरे को यहाँ पे my EBIT came in at 622. If I do 622.08 plus 10% will come to 684, as you can see over here. Next, if I look at earnings after tax into 1 minus t into 0.7, I will get 479. Okay, this I don't calculate because whatever is the depreciation, it will offset the capex and minus increase in working capital. So how will you calculate the increase in working capital? Well, working capital was 25% of sales. So earlier, if my revenue was 4147, 4147.2 into 25%, 1036 was my working capital. Now 4561.92 is my revenue into 25%. 1140 is my working capital and hence 103.68. So ye karega, this will give you 375 for the purpose of terminal value calculation. So these cash flows, remember, will be discounted at the rate of 13%. But when I calculate terminal value, 375.32 divided by, I will take 12% minus G, which is I think 10%. This will give you the value which will be then discounted. So this is 375.32 divided by 0.02. This is around 18,766. This is the value 18,766 which is there at year 4. I need to bring it to year 0. I will discount that by 13% for the first 3 years. This is discounted at 13% and hence this will give you ultimately the value. So this kind of takes care of your broad level discussion for question number, I think 4, question number 7. This is a question I think even in my security valuation of equity shares ka video in my Super 90 also this question I think was there. You can review that if you want a slightly more detailed discussion. Question 8. Following is the information for WXY expected to grow again at the rate of 20% for the next 3 years, after which the growth rate will stabilize at the rate of 8% up to perpetuity. Similar data. You have been given revenues, COGS, operating expenses, and hence if I subtract all of this, 7,500 minus 3,000 minus 2250, this comes to 2250. Capex depreciation which is included in operating expense, so 2250 will be my EBIT. Capex is given to you as 750. During the high growth period, revenue and EBIT will again grow at 20%, which means everything within revenue and EBIT will grow at 20%. So depreciation also will grow at 20% because depreciation is included as a part of operating expenses. If EBIT has to grow by 20%, everything like COGS, revenue, operating expenses, every item within operating expenses like depreciation will also grow at 20%. And the capital expenditure net of depreciation will grow at 15%. So this is a little interesting. So what is growing over here is, we are saying 150 was my capex net of depreciation. Now this is growing by 15%. So what I will try to see is my capex minus depreciation. This is my net value. If capex was 750, depreciation was 600, this was 150 in year 0. In year 1, this will grow by 20%. So 150 plus 20% will come to around 180. Now depreciation is going to grow by 20%. So this is 720 and hence the balancing figure will be capex. So over here 720 and let's say I think 900 will be capex. If I go to year 2, again this will 180 will grow by 20%. 20 or 15%, just a second. Capex will grow by 15%. My bad, capex net of depreciation is growing by 15%. So 150 plus 15% comes to 172.5. So this is 172.5. This is growing by 15%. This is growing by 20%. And hence the balancing figure will be, I think, 892.5. Further, this will again grow by 15%. So 172.5 plus 15%. will be 198.38 and this will be 720 and 20% comes to 864 and 198.38 comes to 1062. And year 3, this is again growing. 198.38 plus 15% is 228.14 and 864 plus 20% will be 1036.8 plus 228.14 and you get 1264. Now, this is a long method. Honestly, in my free cash flow, I will add back the capex and I will subtract the depreciation. So net impact is 172.5. So even if I don't sit and calculate all of these, I can still directly subtract 172.5 and that is it. Because I will add back 864 as depreciation, subtract 1062 and hence net I will deduct 198. That is about it. So over here, you have been told that this will grow at the rate of 15% and from year 4 onwards, the normal growth period, revenue and EBIT will grow at 8% and the incremental capex will be offset by depreciation. So whatever is the capital expenditure will be offset by depreciation and hence the effect will nullify. During both the high and normal growth period, net working capital will be 25% of revenue and the WCC is given to you as 15%. So a little more easier. Here only this capex adjustment is a little tricky. Corporate tax is 30%. You have not been given data regarding any debt. Estimate the value of WXY using the free cash flow and WCC methodology. So you will try to find the workings. Basically, you have the EBIT. You can do into 1 minus 3 and that will give you, let us say, depreciation and that is about it. So यहाँ पे 172, 198 and 288. Ultimately, this will be 0. An increase in working capital is 25% of sales. So you will find, let's say your sales was 7,500 into 25%. That means your working capital at year 0 was 1875. Now the sales become 9,000 into 25%. 2250 is your required working capital, 375 is the additional working capital needed. So this will give you the free cash flow to each of these years and then in the terminal year, that is year 4, you will get 2680. You will discount all of this at 15% and even 2680, you will find the present value at the rate of 15% with the growth rate of 8% and this discounted by 15% for 3 years and this will give you the total value of the firm. Now, these are fairly detailed valuation questions. You would have hopefully and definitely done this within security valuation as well, but nevertheless this kind of tries to bring a wrap close to an hour for business valuation. Apart from that, there is this section where, okay, it's marked over here, but there's this section where we have discussed regarding valuation of startups, distressed companies, going versus non-going, digital platforms, professional firms and ESG theory as well as the numericals. There's close to a 1 hour video with all of these numerical questions. So I would strongly recommend you review that for a better understanding. These are extra questions not there in the study material. As you can see in the study material, there is only theory pertaining to business valuation, which is covered separately in the theory video as well as in this video, which I will share the link. In the initial part of that theory video, you can review all of this. So that kind of takes care of the theory and the practical section of this chapter, business valuation. Put close to this time and kind of get done with this chapter. If you have done these sums earlier, you don't really need to worry about it. But if you have kind of thinking of leaving this chapter, might as well just cover this up. It is nothing new. I don't even know why this chapter separately exists. You can kind of put these concepts into separate chapters and do it. Maybe EVA, if it was not done earlier somewhere, maybe covered over here. Everything else is kind of discussed in any case. Okay, so that should be it. This is business valuation for you. Hopefully this video has been helpful and I'll see you soon with another videos. Till then, keep studying. Good luck and take care. God bless you all.